Hi students, welcome to the video on financial accounting at your fingertips. In this video, we are discussing on dissolution of partnership firm. We have already taken 15 videos based on partnership. Now this is the 16th video on which we will consider insolvency situation. So insolvency situations when the partners became bankrupt or insolvent or unable to meet their debts. So what are the glimpse of the topic? Dissolution under insolvency situation. Some important concepts: solvent partner, who is insolvent partner, capital, what is capital deficiency, when one partner becomes insolvent, how accounting treatment will be done, when two partners become insolvent, and when all partners are insolvent. In this video, we will discuss when one partner becomes insolvent and that insolvency of partner according to Garner versus Murray. Garner versus Murray is very important for all commerce streams where dissolution of partnership firm is a chapter in financial accounting. It is on +2 commerce, +3 commerce, BBA, MBA, then aspirants of JIB. So, in legal terminology, insolvency is a situation where liability of a partner or firm exceeds its assets. Liabilities are more than assets. In practice, however, insolvency is the situation where an individual or firm cannot raise enough cash to meet its obligations, means payment of debt, liability, or they become due for payment. If a partner account shows a debit balance, after making all the adjustment, he is to pay the debit balance to the firm to settle his account. But if such a partner is insolvent, that is unable to satisfy the debt to the firm, then his deficiency, shortage, which he is not able to bring, will be borne by other solvent partners in accordance with the decision in Garner versus Murray. In ordinary sense, when there was dissolution, the deficiency of the insolvent partner are to be paid, are to be met by the solvent partner in their profit sharing ratio. But according to Garner versus Murray, they have to make the deficiency according to the capital which stood just before the dissolution of the firm. So, according to Garner versus Murray, it was ruled that in the absence of any agreement to the contrary, suppose there is an agreement in the partnership deed, in case of dissolution, the deficiency of insolvent partner will be met by the solvent partner in a particular ratio that will be stipulated, otherwise nothing is mentioned, means the deficiency of insolvent partner capital account must be borne by other solvent partner in proportion to their capital which stood just before the dissolution of the firm. So the effect of this ruling is to make a distinction between an ordinary loss due to trading or realization of assets. Suppose there is ordinary loss, means there is loss due to trading, or there is less realization of assets, but loss on the account of insolvency of partner is a capital loss. This is this is trade loss, loss due to mismanagement of trade, or there is shortage, or there is realization of assets is to the little amount. But loss on account of insolvency of a partner is a capital loss. As such, should be borne by other solvent partner in proportion to their capital. So the practice before this decision was to share the deficiency of the solvent partner, insolvent partner, by the solvent partner in their profit sharing ratio. There no distinction was observed between trading loss and capital loss, but according to the Garner Vs.Murray, the loss or deficiency of the insolvent partner will be solved or will be paid or will be borne by the solvent partner according to the capital proportion of their capital stood before the dissolution of the firm. Here we will solve one problem based on one partner become insolvent, how there is accounting treatment, how we will prepare the relation account, capital account and bank accounts. So the given problem is so here it is given where capital are fixed. Under also that insolvency account, we suppose we are following or the firm is following fixed capital method, then the deficiency of the solvent partner will be borne by the insolvent partner according to the fixed ratio of the solvent partner. But if they are following the fixed installment method, that is fixed capital method, means they are preparing both capital account and current account, then the whatever the adjustment after preparation of current account and capital account, the deficiency is borne by the capital which stood before the dissolution date. If it is fluctuating capital method, only one current account will maintain, then that will be done according to the balance of capital accounts. Only capital account is maintained. So in this problem, X, Y, Z are sharing profit losses. X, Y, Z are sharing profit losses in the ratio of half, 1/3, 1/6. That means 3:2:1. And their balance sheet is as follows. Balance sheet. Assets, liabilities. Under assets, land and building 57,000. Then stock 50,000. Then sundry debtors 50,000. Then bank account 3,000. Then Y's current account 2,000. Y's current account debit balance. Here they are following fixed capital method. Y's current account, it is debit balance to the extent of 2,000. Then Z's current account. That is amount is 5,000. Then profit loss, accumulated profit loss debit balance, that will be adjusted by debiting the capital account of partners in the old profit sharing ratio. So total comes to 1,68,500. Then liability sides. Under liability sides, creditors 40,000. Then bills payable 7,000. X loan account, that is 10,000. Then X capital, Y's capital, Z's capital. X capital account, that is 90,000. Y's capital account, that is 10,000, and Z's capital account, that is 10,000. Then X current account 1,500. X current account 1,500. So total comes to 1,68,500. Then in the question it is given X, Y, Z sharing profit losses ratio of 1/2, 1/3, 1/6 respectively. Decide to dissolve the firm from 1st January 2022 as the balance sheet as follows. So balance sheet as on, that is 31st December 2021. That is here it is first. It is based on financial years, the calendar year. That is, so it starts from 1st January and ends on 31st December. Then land and building were sold for 40,000. Land and building sold for rupees 40,000. Then stock and debtor realized 30,000. Stock and debtors realized 30,000. Then and 30,000 and 42,000 respectively. Stock 30,000 and debtors 42,000. Goodwill sold for 600. Goodwill 600. Then the expenses on realization was 1,200. Expenses on realization 1,200. 1,200. Z is insolvent. Z is insolvent, and a dividend of 50 paise in a rupee received from his estate. 50 paise in a rupee received from his estate. 50 paise for 1 rupee received, 50% received from his estate. So prepare from his estate. So pass necessary journal bills to close the books of the firm, applying the ruling of Garner versus Murray. So Garner versus Murray, I already discussed. According to Garner versus Murray, any deficiency of the insolvent partner will be borne by the solvent partner according to the capital which stood just before the date of dissolution or preparation of realization accounts. Then under fixed capital method, the ratio of sharing the deficiency of insolvent partner by the solvent partner according to the fixed capital ratio. Here the fixed, here capital account and current account maintained, so it is based on the firm is maintaining the fixed capital method. So ratio of sharing the deficiency 90,000 is to 10,000 is to 1,000. Here Z is insolvent, so 9 is to 1 is their sharing of deficiency. Whatever deficiency, that will be shared between X and Y, solvent partner X and Y, in the ratio 9 is to 1. So we will prepare one realization account. So we will prepare one realization account. First relation account. We already discussed while preparing relation account, whatever the assets of the firm that will close by transferring to relation account. When relation account debited to sundry asset excluding cash in and cash at bank and debit balance of, that is any profit and loss, that will not be taken. So excluding that, so we will write to sundry assets. Here sundry assets include land and building 57,000, then stock 50,000, sundry debtor 50,000. So total comes to 1,57,000. 1,57,000. Then liability side, creditor and bills payable will be taken by liabilities. By creditors 40,000, by sundry liability, or we can write by creditor 40,000, by bills payable, that is 7,000. Here relation expenses is given 1,200. So general relation account debited to bank account, that is relation expenses, that is 1,200. Then assets are sold. Land and building 40,000. Then sundry stock 30,000. Then sundry debtor 42,000 and goodwill 600. So total comes to 600. Then to 1,12,600. 1,12,600. So to bank, realization of assets. Realization of assets, that is 1,12,600. So payment of liability by bank, that is payment of liability. Sorry, here relation of asset is bank account debited to relation account, that is relation of assets. Relation of assets, because when we are selling the assets, actually what debit what comes in, credit or goes out. So generally should be bank account debited to asset account. As assets are already closed by transferring to relation account, so whatever we done, that will be through relation account. So bank account debited to relation account. So we are preparing relation account here. So on the credit side, write by bank relation of asset 1,12,600. Here we are paying the liability. So write relation to bank, payment of liability, liability to the extent of 47,000. 47 payment of liability. Then another loss on relation is given. That is, the accumulated loss is given. So when there is accumulated loss, we will prepare one current account, and capital account, then current account. So here we are preparing current account of partners. That means we will prepare XYZ, then XYZ. So this is XYZ, XYZ. So debit balance, this is credit. Here already what is written, X current account and X current account is only credit balance. So write by balance brought down. The amount is 1,500. Then Y date debit balance. So two balance brought down. Two balance brought down. Y is 2,000. Z is 5,000. Then we will prepare the capital account of partners. Capital accounts. Under capital account comes, that is XYZ, then XYZ. So XYZ. Here opening balance, by balance brought down. The amount is given X 90,000, Y 10,000, Z 10,000. Then there is loss. When there is loss, we will debit the capital to profit and loss account. There ratio is 3:2:1, 6. So 1,500 divided 6, 250. 250 into 3, this is 750. This is 750. This is 500. This is 250. So loss is adjusted. So here we will see whether there is realization profit or loss. Here debit total is 1,57,000 plus 1,200 for loss 47,000. So this is 200, then 5, then 0, 2. 2,05,200. 2,05,200. Then here it is 47, 1,59,600. So there is loss. So loss means we will write by loss on realization transferred to capital accounts. So loss is 2,05,200 minus 2,05,200 minus 1,59,600. So this is 600. Then 45,600. 45,600. So landed building taken. 40,000 stock taken. 100 are taken. Bank account 3,000. Profit loss adjusted. Then 40 X loan account. So X loan account is there. We'll write liability by X loan account. X has given loan to the business to the extent of 10,000. This is 10,000. So here there is realization loss 1 lakh. That is 45,600 in the ratio X, Y, Z. So 48,600 divided by 6. 45,600 divided by 6. 7,600. So 48, 7,600. 7,600 into 3. Here 0, 0, 22,800. 7,600 2, 15,200, 15,200. 7,200 into 1, 600 into 1, 7,600. So total comes to 48,600. So total comes to now 2,05,000. So realization loss is there. We'll write to realization account loss. Realization account, that is loss. Loss is, here it is 22,800. Here it is 15,200. Here it is 6,000, 7,600, 7,600. Here the loss of the solvent partner should be brought by them in terms of cash. So first we will write by bank. They will bring their share of loss. So he will bring, X will bring 22,800 and Y will bring 15,200. As J is insolvent, he will not bring anything. And here we have to calculate what is the deficiency of Z. Z's debit balance is 12,600. Z's debit balance 16,000. So it will be closed. that is, then it will close and transfer to the capital account. Here it is 12,600. So 12,600 means current account debit, Z's current account debit will credit it and debit Z. Z's capital account debited to Z's current account. Z's current account. The amount is 12,600. 12,600. So 12,600 plus 250. That is 12,600 plus 250. 12,850. So 12,850 is his debit balance. Credit balance is only 10,000. So shortage is 2850. Deficiency is 2850. On 2850 he will bring 50%. So 1425 he will bring. So he will bring 1425. That means we will write when Z will bring, we will write bank account debited to Z by Z's capital account or by bank credited by Z. So here is bringing 1425. Another 1425 will be brought by X and Y in the ratio of 9:1. 9:1. That is 10. So 1425 divided by 10. Here it is 142.50. Another, then into 9. Here 1 2. So it should be 5 1425. So he will bring 142.50. So here by X account debited, Y account debited to Z, to Z's capital account, Z's account. That is X account debited, Y account debited to Z's current account, Z's capital account, because here already it is transferred to its capital account. So here we will write by, here we will debit, here we will debit the current account of X debited with current account of X to Z's capital account. So under current account we will write, here it is 142.5, 9:1. Here 1282.50. Here that is 142.50. Here we will adjust by X current account. The amount is 1282.50. Here by Y's current account. Here 14250. So total of Z is adjusted. 12,680. Here X account we will see. Here in the X capital account we will close by transferring to his current account. Here X capital, that is 1 lakh, to X current account. Here it is 1 lakh minus 750. 1 lakh minus 750. That is 99,250. 99,250. So by opening balance, so we will write to balance. Here it will be transferred to current account, to X current account. So X current account credited by X capital account. How much? it is 99,250. Here it is, here Y's capital was 10,000, debit 500, so 9,500. 9,500 here write by Y's capital account, that is 9,500. So debt's capital account is already adjusted, that is already transferred to his current account close. Then here we will calculate how much will pay to X, how much will pay to Y. So X total is, that is 1,500 plus 22,800 plus 99,250. 99,250 is credits. So amount is 50. 1,23,550. Then debit total is realization loss 22,800. 22,800 plus 1282. 22,800 plus 128250. 128250. So total comes to, that is 50, then 820, then 24,082.50. So total I have done here. Total is this 1,23,550. Then debit balance is 24,082. 24,082.50. So deduct. So write to bank. So X will get, that is 50 paisa, then 7, 6, 4, 99,467.50. 99,467.50 paisa. Then Y 15,200 plus 9,500. So total comes to 700, then 24,700. And debit side is here 2,000 plus 15,200, so 17,200, 17,342.50. 17,342.50. Its credit balance is 24,700. So 24,700. So he will take cash to the extent of 50 paisa, then 7, then 5, then 3, 7. 7,357.50. Then we will prepare one bank account. We will prepare one opening balance of 3,000. We will prepare one bank account. 3,000 opening balance. So bank account having 3,000 opening balance. So we will prepare bank account. The opening balance we will write, it is assets. Real account we will write to balance brought down 3,000. To balance brought down, that is 3,000. Then assets are sold. Assets are sold for, that is 1,12,600, right? Bank account debited to realization account, sale of assets, realization account, sale of 1,12,600. Then we made the expenses in relation to bank. Bank by realization expenses 1,200, realization expenses 1,200 by realization account payment of liability, realization account, that is payment of liabilities, that is 47,000, and he will pay. We receive 1,425 from ZC State, so bank account debited to Z's capital account, the amount is 1425. Then realization loss borne by X and Y by bank. So bank account debited to X capital account 99,250 to X capital account 99,250. Then to Y's capital account share of loss brought in, that is 9,500. No, it is here 22,800. X capital X brought 22,800 and Y brought, here it is 22,800, 15,200 share of loss, it is 200. Then X is paid by bank, X capital account debited to bank by X current account. X current account is, here it is written 99,000 or 8750. Then by Y's current account amount is 735750. So bank should be tallied. Here 25 1,55,25. So here hours 1 2, that is total was, here it was written 1,23,550 minus 21, that is 24,820. So here 467. Here it is 467 instead of it should be 467. So 1,55,020. So bank account is already closed. So here on insolvent of any partner, bank accounts is automatically closed after settlement of account. That means here we are preparing on the realization account. On the realized account, all assets and book value will be transferred to debit side of realized account, and all liability at book value will be transferred to credit side of realized account. Then we will charge the realization expenses, realization expense account debited to bank, that is here 1,200. Then we sell all the assets. So whatever assets sold, we will write bank account debited to realization. So realization credited by bank 1,12,600. Then all liability we paid. Liability was 40,000 plus 7,000, 47,000. So to bank, realization account debited to bank, payment of liability after balancing, the debit side is heavier than the credit side. So it is debit balance means loss on realization of assets, loss on realization account, that will be debited to capital account of all partner in their old profit ratio, that is 9:1:1. So we have debited their account with 22,800. So we prepared one current account and a capital account. In the capital account, we have posted 90,000, 10,000 to the credit side of the capital account, and X loan on also posted on the credit side of X capital account. Then on realization loss, whatever loss on realization, that will be brought in terms of cash by the solvent partner. Here XY are solvent partner. Realization loss of X was 22,800. Realization loss on of Y was 15,200, so they brought by bank with 22,800 and Y 15,200. Then Z's account, on Z's account we will see the current account. Z here, Z is having only debit balance to the extent of 12,600, that will close by transferring to his capital account. So Z's capital account shows 10,000 opening balance. Required is debit balance is current account debit balance is 12,600, and another profit loss, unrestricted profit loss in the balance sheet was given, that will be adjusted, debited to the capital account all partner XYZ, that is 750, 500, 250, ratio of 3:2:1 as per their profit and ratio. Here the debit side, debit capital of Z is 12,850, opening balance is 10,000, so 2,850 is deficiency, and that is given his assets realized 50 paise in a rupee, that is 50%. So 1425 he brought in terms of cash, that is by bank 1425. Another deficiency 1425 will borne by the solvent partner according to their fixed capital. The fixed capital is 90,000, 10,000. So 9:1 they share, and so X share 1282.50 and Y share 142.50. Then XY's capital account will be total. X capital account debit side, credit side was 1 lakh and debit side was only 750. So 99,250 will be transferred to his current accounts. So by X capital credited by X current account 99,250. Similarly, Y's capital account was 10,500 is the loss, so 9,500. 9,500 will be credited to Y's current account, credited by Y's capital 9,500. Then finally the XYZ account already closed. XY will total. The credit side is heavier than the debit side. Then he will receive the payment. So to bank 99,467.50, and Y will get the payment to bank 7357.50. Then we will prepare one bank account. The opening balance was 3,000 and sale of asset proceeds was 1,12,600. Z paid in terms of cash out of his estate 1425. X has already brought his share of loss 22,800. Y brought his share of loss 15,200. Then on the credit side, the realization expenses 1,200. Payment of liability, that is realization account, payment of liability 47,000. Then X will be paid 99,467.50. Y will be paid in terms of check for bank, that is 735750. Both the total of bank account debit total, credit total is 1,55,025. It is automatically closed. It shows that there is accuracy in the accounting process. That means we have correctly prepared our relation account and current account of partners and capital account of partners and bank account. Thank you for watching this video. Don't forget to like and share the video to all of your friends so that everybody will be benefited. Don't hesitate to subscribe if not already subscribed. In the next video, we will prepare the accounting treatment when two partners or more than two partners become insolvent.